So what was that you just asked me?
So basically, my 14-year-old came to me and was like, Mom, I heard something about the bank's collapse. I was like, you know what? That would be a great question to ask your dad.
Oh, all right. I wonder where he heard that. But I guess it's all over the news. And but then do 14-year-olds watch the news? CNN, Fox News,
I'm sure it comes up
CNBC.
in TikTok.
True, true. All right. So the banks have collapsed, but not all the banks. These were not among the big four banks like J.P. Morgan Chase. It wasn't Bank of America. It wasn't Wells Fargo. It wasn't Citibank. Thankfully, I think that if those banks were to collapse, we would literally see the end of financial times as we know it. Like that would be economic collapse, total. But so far, we have seen three banks collapse in the last 6 months. The first one that kicked off the collapse was Silicon Valley Bank. They're out in California. I don't know if they have any other branches, but they were mainly serving the tech industry. A lot of tech companies had bank accounts with Silicon Valley Bank. Then we had Signature Bank. They failed, and First Republic Bank has failed. Now, you asked me, what does it mean when a bank fails?
Yes.
So basically what this means is that the banks have become insolvent. So probably the next question is, well, what does insolvent mean, right? So basically, when you go to the bank and you put money in, you have an account with a bank, you put your money in your bank, in your savings bank account, and they pay you a little bit of interest. You ain't making no money on this. Chances are the amount of interest that you're being paid is well below how much inflation there is. So it's still losing money. But the bank makes a promise to you that they're going to keep your money safe, and you can come get it when you need it, and you don't have to worry about it, right? Well, the bank will then take your money and lend it out to somebody else. And the banking system has a rule called the fractional reserve, which allows a bank to lend up to 90% of their deposits out. So when you put $1,000 in your bank account, that $1,000 is not just sitting there waiting for you to come get it later. The moment you put that money in, the bank is already looking for people to borrow money from. That's why the banks spend a lot of money on ads. And so they will lend your $1,000 out along with the next person who's also got a bank account that's got another $1,000 in there. Somebody's got $50,000 in their bank account. Anyway, whatever the case is, they have all this money that's been left with them. They then lend this money out to people who need loans. They will lend it out for car loans, mortgages, credit cards, all these different credit cards that are available. They're always offered through or are backed by a bank. Capital One, Bank of America, your store cards, your Bed Bath & Beyond, your Macy's cards, your Home Depot cards. All of these cards are backed by a bank. And so, JP Morgan Chase, my Amazon credit card, like all these different cards are backed by banks. So, well, where did the bank get the money from? Well, the banks largely are getting money from depositors. And so if they lend out, let's just say a bank's got $1 million, and based on the fractional reserve system, they can lend out up to 90%. That means they can lend out 900 grand, and they only have to keep $100,000 on hand.
Okay, I have another question. So what about if you're actually online and you're online and you're checking your bank account, and it says, I have $100,000, and you go to the bank and you try to take that cash out, then what?
Well, good luck, because most banks will tell you, we can't give you your money, because most banks don't keep $100,000 in cash on hand. They used to, and maybe it depends on what bank branch you go to. Maybe it's a busier bank or a larger bank, and maybe they keep more cash on hand. But most banks, if you need to pull out what they call a large sum of money out at one time in cash, number one, they're going to ask you to fill out some forms. Number two, even though it's your money, but number two, chances are they're probably not going to have enough. They're going to tell you, hey, come back another day so that we can have an opportunity to collect the money that you're asking for. So, but the problem is, the reason why these banks have collapsed, there were a greater number of people trying to withdraw money from the banks than the bank had on hand. And basically, let's just say again, there's $1 million deposited into the bank. They only have to keep $100,000. But if every bank owner or if every bank account holder said, hey, I want to take my money out, the bank wouldn't have the $1 million because it's already lent out. So the bank, depending upon those investments, they could liquidate those investments. Like, for example, Silicon Valley Bank, they invested in like 1, 2, and 3. I think it was like 1 to 3 year treasury notes at like 2% interest rates, right? Now, technically, they could have sold those treasuries to come up with the money to give the bank account holders their money back. But the problem is that since interest rates have been going up, I need to adjust this camera. Since interest rates have been going up, the value of the investments that they had made had gone down. And when so many different people started asking for their money back, they were losing money by selling the investments that they had put the money into because they were caught in a situation where they didn't have enough cash and they had to liquidate to be able to get the cash, to be able to get the account holders their money. And so every time that they were doing that, they were losing more and more money. Ultimately, the bank became insolvent. And then FDIC, you probably have seen those little FDIC stickers outside of the banks. The Federal Deposit Insurance Corporation stepped in and bailed out the bank. Now, technically, they bailed out the account holders because a lot of those account holders had more money than what the FDIC was insuring. So the FDIC, they only insure up to $250,000. But so what that means is if you have $1 million in your bank account, in one bank account, and that bank fails and the FDIC comes in and saves the day, they're only going to cover you for the first $250,000. So the extra $750,000 gone.
So the other question is, are banks safe?
I think some banks are safer than others.
Okay.
I definitely think that some banks are safer than others. People have been considering credit unions as an alternative more so lately because there's less of a concern about the credit unions. But I think technically any financial institution has the capability of failing. All of this banking is based on trust, and it's based on normal circumstances. Most people will not deposit money and then the next day come back and ask for all of it. So as long as people trust the banking system and don't do erratic things in mass, in most cases, the banking system is safe. But then when you have anomalies like we've experienced recently after the Federal Reserve started raising interest rates, this put a lot of banks that were making risky bets in a precarious situation that left them without very many moves to be able to make. So Silicon Valley Bank definitely became a victim to that. I don't know if they're a victim or if they just poorly calculated the risks associated with the situation they put themselves in. Because at the end of the day, these CEOs of these banks, these executives, these highly paid chief financial officers, CFOs, these accountants, they know the risks. They're paid enough to know what they're getting these banks into. So, I don't know if I can quite feel bad for them, but these are the risks that they took, and this is where they found themselves. What you think about that?
It's a lot.
It is a lot. It's a complex system, and a lot of people haven't had a reason to really understand the banking system until now.
Yeah.
Like, no one really cares about banks until there's a problem. You put your money in. Whenever you stick your ATM card in the machine, the money comes out when you need it.
Yeah.
As long as everything works, no one asks any questions. Online banking works, bill pay. But the moment there's a problem, now it's like, all right, what's going on? I need to know.
And do I want to take all my cash out?
Yeah. And do you want to take all your cash out?
Then that's the thing. If you're trying to take all your cash out, you really can't.
You can't unless you're one of the earlier withdrawers.
Okay. True.
Or earlier people to withdraw their funds. But, that's why I personally like to diversify my deposits. So I don't want to have all my money in one bank. Number one, I want my money working for me. I want my money growing and compounding and making money while I'm sleeping. That's the goal. You should always be, that's always been the goal. But, I'm diversifying my investments in the stock market, ETFs, multiple ETFs, different types of ETFs, multiple different types of brokerages, Vanguard, Charles Schwab, Merrill Lynch, E-Trade, Robinhood, M1 Finance, multiple different types of savings banks, the big boys, your JP Morgan Chases, your Bank of Americas, but also the smaller regional banks. I have money in credit unions, like all, for the most part below the FDIC coverage amounts. And for credit unions, they don't use FDIC insurance. They have it's like NCUA or something like that. And don't ask me what that means, but it's basically insurance. So what do you do?
I mean, you just answered. I think it's just best to put your money everywhere else, not just, one bank, because you just never know what goes on in that particular bank. So.
And you don't know what kind of risky investments some of these banks might be putting your money into, which might make them more likely to fail.
True.
But I understand, the banks got to make money. If they just sit here, if the banks just took money in, held your money, paid you interest, and didn't lend it out, they would be losing money on a daily basis. So they got to make loans. They got to have credit cards and, have interest rates that are greater than what they're paying out. It makes sense. But yeah, guys, so that's what I would do. That's in a nutshell what happened with the banks, why the banks collapsed, or why Silicon Valley Bank collapsed. Part of why. This is a very high level overview of what happened on that one. But that's what I would do if I was trying to protect myself from future bank collapses. I want to be thoroughly diversified into multiple different banks, multiple different asset classes. Because at the end of the day, you got to remember, the wealthy will continue to get wealthier. They say the poor get poorer, the rich get richer. Well, the rich people will keep getting richer. So where are the rich people putting their money? When you figure that out, start doubling down on that, diversifying your assets. I'm talking real estate. I'm talking equities, gold and silver, bonds. There's treasuries, businesses. There's a lot of money in businesses through their assets, different assets that the businesses own. So, and the list goes on and on and on. I mean, hell, I know a lot of businesses that are investing in domains. Like, some businesses are buying land. They're putting these different assets into different trusts. So, there's a lot of different places you can put that money. Now, some places you put money are more liquid than others, but there's a reason why you would use these different asset classes to be able to diversify and protect your wealth. Anyway, I hope you guys got some value out of this one. Drop me a like, drop me some questions. Let me know what you guys are thinking about this one. What worries do you have with the whole banking system right now? Are you worried about your bank? And are you worried about your investments? I'd love to hear from you guys. Drop me a like, subscribe. Catch you on the next one.